Hello and welcome to another episode of Smart Money. Now, in today's episode, we will help you understand how to build a portfolio at a time when there are two big events upon us. One, of course, the elections, and two, we're probably entering into a rate-cutting cycle. We will be drilling it down to specific themes and funds and also take up all of your queries. Joining us today on the show is Anupam Guha. He is the head of Private Wealth Management and Investment Advisory at ICICI Securities. Now, Anupam has over 15 years experience in the private banking business, both in India and overseas. He is one of the founding members who helped set up the private wealth management business at ICICI Securities as well. Anupam, thanks a lot for joining us here in the studio. You know, first I want to ask you about what your approach is to portfolio construction for clients as we are heading towards the 2024 general elections. I'm asking because this is, in any case, a very challenging time for the market, and now we have both the start of a rate-cutting cycle and the elections upon us. How does one construct a portfolio?
Yeah, thanks, Sonia, for having me at the show. When investors ask us, I think, our response is really that the broad concept of portfolio construction, revolves around the concept of asset allocation. And asset allocation is nothing but a structured method and a framework for really, one, understanding the investment objective of the customer, of the investor. And second, then is to create the framework of, putting that money in various asset classes. Now, if I were to just, kind of explain, like in personal finance, we all know the personal part tends to be far more important than the finance bit, right? Because the same advice that, I give could mean different things to different people. So, the 5 things that one needs to really look at when creating the asset allocation framework in terms of setting the objective. One is in terms of the return expectation of the investor, the risk appetite that an investor may have, the liquidity, what kind of cash flows does he need, what is the tenor of investment that he's looking at, and really the taxation bit. Once we've established that, then really, you create an asset allocation framework, which broadly has 2 components. One is the strategic asset allocation, the other is tactical. Strategic is long-term, really in line with, the framework that we've created. But tactical is where, one can really take positional calls, depending on how you see the macro, the market, and election, or the 2 events that you spoke about, really gives an opportunity for investors to kind of do some tactical, rebalancing, rejig, and take this as an opportunity for building a portfolio. Okay, that's interesting. So how do you see the past elections and the returns from the market? Is there a correlation? I mean, for someone, say, if somebody has been in the market for 20 years and has not really bothered too much about the election and the outcome, is that a fair way to look at it, that elections come and go, but I shouldn't really tamper with my portfolio? Or do you think otherwise? Yeah, so you actually, you said it. If you look at the last 4 elections, right, 2004, 9, 14, and then 19, right, you've had 2 UPA governments, 2 BJP, NDA governments, right? And if you look at the returns that came out of post those elections, in the near term, there would be volatility, because election is nothing but an event where there is an uncertain outcome, right? And that really makes our investors anxious. But really, if equity is, is something that you are looking at, or even from a debt perspective, broadly, you have a 3-year horizon. In a 3-year horizon, post-elections in each of these last 4 elections that have happened, investors have made double-digit return. So VIX or the volatility index typically tends to go up as you come closer to elections. But for long-term investors, it's really to, kind of hold your fort and really play to the India story. Okay, play to the India story. So tell us a little bit about the themes, right? Over the next 12 months, given that we have elections upon us, as well as we have, a couple of other, perhaps a rate-cutting cycle as well, which are the sectors that you like at the moment and one that investors can participate in? Yeah, so one is that we are broadly, quite constructive on the markets. Because, as I said, the India story, if you look at what's happening, be it reforms, the growth in infrastructure, the Make in India story, the digital story, regulation changes, both, the cleanup of balance sheets in India, I think it augurs extremely well. And, what we were discussing a while back, it seems to be a great place to be in India, because really, when you look at a per capita GDP movement from 2,500 onwards, right, what we've seen in China 20 years back, you really see the markets doing well, the economy doing well. And in context of that, specific to your question on the election bit, I think if you were to look at it, there are 2-3 sectors that really look appealing from a 12-month perspective. One is, in this budget, government has actually provisioned or budgeted for almost 10 lakh crores of capex expenditure, right? And if you see capex expenditure in the last 3 years, actually it's gone up by almost 33%. So in context of that, we feel that there is going to be a push in infrastructure, there's going to be a push on capital goods, and these 2 sectors look good. Also, to your point that you mentioned in terms of the interest rates, we are near peak. Yeah. And at some point of time, there is an expectation. Maybe it could be slightly more delayed than maybe later towards the end, in case if interest rates were to come down. And I think, with in terms of commodity prices and raw material, which has had, I would say, a volatile phase, I think it is all getting stabilized, which means that margins will get normalized. And when margins get normalized, you would see sectors like cement, steel, auto, FMCG all doing well, right? So on one side, you have the infra and the capex, 2 core themes that and capital goods that one could look at from an investments perspective. And from a margin normalization, I would say some of these sectors also look good. Over and above that.
Just one follow-up here. So since we're talking about the rate cutting cycle, right, the fair assumption is that all the rate sensitives will do well, especially pockets like real estate. I mean, if the rates start to fall, it will be better for home buyers, perhaps. So real estate stocks will move. Is that a good way to look at it? I mean, is there alpha generation in some of these spaces? I mean, they've rallied quite a bit up until now already.
Yeah. So from an alpha generation perspective, I mean, when we do portfolio building, there are 2-3 things that we look at, right? I spoke about asset allocation as a core theme. And there are enough research papers which say that, listen, if you have to pick one thing which really has contributed to alpha creation, it is the asset allocation bit. Because if you look at broadly 3-4 parts of this various assets that are available for an investor to invest into, which would mean, say, for example, an Indian equity, it would mean global equity, it would mean debt, and, say, for example, gold on the alternate side. And if you look at the last 10-year data, the gap between the best performing asset class and the worst performing is closer to 20%. That's big, right? Which means that, say, for example, last year gold did well. Before that, equities did well. 2019, global equities did very well. Before that, 2018, debt was the best performing asset class. So from an investor's perspective, I think it's very important that you really build a portfolio which has components of these asset classes. The second part, within the investment that you're doing, and more so from an equity perspective, the point that you made, the sectors that one would want to look at, like real estate that you spoke about, right? If I were to look at some of the sectors, be it banking, IT and pharma, I mean, just post-COVID, if you were to look at those 2019-20 returns, IT and pharma were the best performing, themes or baskets. Now, obviously, like last year was FMCG. Before that, it was metals. So really, in case if one believes that interest rates are going to fall, right, rate-sensitive sectors will do well. And I think it is those tactical allocations that would really give a lot of, alpha to a client's portfolio.
Okay, let's do one thing. Let's take a short commercial break. We also are getting a lot of queries from our viewers, so don't go anywhere. We'll come back with our guest in just a bit. We'll also try to drill it to specific mutual funds, specific, assets that you can invest into. More on that coming up in a bit.
Anand Rathi presents Power of Vision, Stories of Wealth Creators in association with CNBC-TV18.
Hello and welcome to Anand Rathi Wealth Limited presents The Power of Vision, Stories of Wealth Creators in partnership with CNBC-TV18. I'm your host Pavitra Parekh, and today we have with us Mr. Feroz Aziz. He's Deputy CEO of Anand Rathi Wealth Limited. What are some tips that you could give to someone who's trying to get into the markets, but just sort of maybe mistakes to avoid?
One thing which I've seen is people buy high and sell low. It's just the opposite of what their desire is. Now, let me give you an example. 1 year back, 1.5 years back, everybody wanted to buy a NASDAQ fund. There was one NASDAQ fund which went from 1,000 crore assets to 11,000 crores assets. Okay, and then it fell 35%. Actually, people lost 3,500 crores because they were chasing performance. Don't ever chase performance. It's not so easy. It's not a fixed deposit that you chase performance, right? If a bank gives you 9, you just have to grab it. That's a fixed deposit, but this is not a fixed deposit. So never buy high and sell low, which is a normal human tendency. And when you look at the trends in the mutual fund industry, it is very apparent. This is the first time I'm seeing one trend where people are buying low and selling high, is the small cap funds. Last 5 years, small cap was underperformed, but you still see influx of money coming in the small cap funds, which is the first time in my looking at some data. This is the first time Indians are being smarter.
Now about just cash flows, managing cash flows, take us through the importance, and then how do you really go about it? Because this is also something that might sound easy, but it's really not.
See, cash flows have to be holistic. Most people look at their portfolio in constituents. For you to manage cash flow, you will have to draw a table of everything you have. Seldom do I meet somebody, even an HNI, with a guy with 20 crores does not have all his wealth on an Excel sheet every dime. So having an Excel sheet of your full portfolio across all 12, 15 different categories of investments you may just have got yourself into is very critical. So cash flow cannot be transaction-wise. It has to be holistic. That's point one. Point two is cash flow planning will require estimating your future revenues. Like a company projects its future revenues. In that balance sheet of yours, you should also put your P&L, which is nothing but your cash flow. That's when you will be able to arrive at this financial year, what's my expense, what's my total income. You might get some dividends from the stock, that's your inflow, right? So you will have to make it holistic, point one. Point two, you will have to also project your revenues like a company does. That's when you will be able to get the two variables other than the expense which you always know.
Anand Rathi presents Power of Vision, Stories of Wealth Creators in association with CNBC-TV18.
Welcome back to Smart Money on CNBC-TV18. Well, we have with us Anupam Guha, who is the head of private wealth management at ICICI Securities. And here we are trying to build a model portfolio for you so that you don't have to do all of the thinking. We're going to tell you how to approach large events like the elections, which are upcoming next year, as well as perhaps the start of a rate cutting cycle. So, Anupam, before the break, very helpfully you told us about all the factors that are leading to these big events. But now let's get down to the brass tacks, right? Because that's what our viewers want to know. How do you build a model portfolio if you're a growth client, you know, someone who's a growth investor, someone who's younger, between 20 to 35, and what are the mutual funds that you would recommend?
Sure. So, for a growth client, Sonia, really one is that it needs to have, from a strategic perspective, almost 80% in equity, right? And within equity, given the valuations, right, be it large cap, mid cap or small cap, all seem to be fairly valued at this point of time in terms of their long-term averages. So from that context, my suggestion would be, and I'm going to maybe first cover, the large cap, mid cap bit, and then maybe specific, funds. Almost 35% should be at least in large capish. And there our suggestion would be, at least, my view would be that you play it either through index funds or ETFs. Because, in large cap, it is better that you look at expenses and try and kind of mimic the market, so to say. And hence, index funds and ETFs work best. In that, you can pick any of them, say an ICICI Prudential, Nifty ETF, or an SBI or an HDFC, all works good. Right. In terms of adding more, I think FlexiCap as a category looks very good. almost 75% of money is in large cap, with tactical, 25% between mid and small cap. So really, there, rather than for a investor doing those tactical call, really the fund manager is able to do that. And in flexi cap, you have actually, Canara Robeco, say for example, flexi cap fund. So between these two, the ETF and the index fund and the flexi cap fund, almost 35% of allocation can be there.
You have hybrid funds as well. That's the ICICI approved multi-asset fund.
Yeah. So if I were to just to complete, right, apart from that, you have the small and the mid cap.
Yeah.
Over and above that, once you've built a 60-70% allocation, typically from a tactical perspective, you have 20%. My sense is one can really have 20% in thematic funds and 20% into, because election also brings in volatility, right? And a multi-asset fund, we just saw, right? It really blends in good because it toggles between equity, debt, and alternate, right? So it is also, for investors who would want to take a debt allocation today, given the taxation. So while from a young millennial, etc., the taxation could be on the lower side, but I'm saying even then, right, it is good to have a multi-asset as a category because it really fits in. Also, I would say that on the thematic side, right, and some of the sectors that we just kind of spoke about, banking looks very good. As a country like India, where you have so much of growth coming in, banking is a surrogate to really play the full India story. Also, banking is another surrogate to play the infra story because typically banks would lend, and that's how you, be it real estate that you spoke about or infrastructure, it becomes a great way to look at this thing. So a banking fund should definitely be there. Given
I notice you also have the Tata Infrastructure Fund. I want to jump in there because a lot of savvy investors believe that you should stay away from thematic funds because as an investor, perhaps it will be very hard for you to time these funds, when to get in, when to get out. And then suppose you forget and you don't have a savvy investment manager for you,
Sure.
then, you might just burn your fingers on the longer term. Would you agree?
Yeah, I would agree. I would agree that if you are a buy and hold investor, then it is best to move into the flexi cap kind of strategies or multi-asset strategies, depending on what is your preference. Because here the fund manager is going to toggle between various asset class in multi-asset or in flexi cap between various large cap, mid cap, small cap. Also, you have the dynamic funds, which is, say, for example, a balanced advantage fund, which toggles between equity and debt, right? And depending on the market valuation, one can really look at building a portfolio. Now, for investors, I think it's very important to understand that, you will, if you want to increase your alpha, right? Finally, one is to really preservation of wealth. The other is, in terms of creating those
Alpha generation.
Higher return. You may want to choose, like election as an event, to play some of these themes. But if you think that, no, listen, this is not my cup of tea and I do not have the time or the bandwidth to really look into it, then maybe, yeah, I agree with you, Sonia, one could just stick to the basics.
Okay, let's do one thing. Let's also get some queries on board now. I guess
Sure.
my director will just put them up for us on the screen. We have lots of queries coming through from many of our, people who follow us, write into us. There's the first one from Susanna Paul, who says, could you give us some suggestions in debt fund category? Because there are so many debt funds and it gets very confusing. This I agree, because, this is a slightly difficult area to understand as well for a common investor. What would your recommendations be?
Yeah, so on the debt side, our belief is that we are almost near peak in the interest rate cycle, which essentially means is that if you today invest, there are actually three components to the investments into debt, right? Conceptually, I think investors should know. One is the concept of carry, which means that if you invest into a paper or into a fund, there is a certain yield or a return that one can expect. Right? It's like an interest rate. So say, for example, today for a paper which is between, say, 3 to 5, one could look at a carry of anywhere between 7.5% to 8%. And if you believe that interest rates were to come down over the next few quarters, then you also have the benefit of the duration play, which means that you really can, get capital gain, like how you have it in equity, because interest rates and bond yields are inversely correlated.
Any names that you want to suggest?
Yeah, so my suggestion again would be that, like how you mentioned on people just want to buy and hold type, there are dynamic bond funds. Now, what does a dynamic bond fund do? That's a name of a category. You could have an, ICICI Prudential Dynamic Bond Fund, an SBI, an all seasons fund from ICICI Prudential or from HDFC, any of the, large players in the debt side. But really what's the play is there is basically playing the, short term as well as the slightly medium term in terms of interest rate. The other thing that, investors should look at when investing into debt is really from a taxation perspective.
Okay.
If you are in the lower tax bracket or tax is not a consideration, then it's very easy for you. But, in case if people have, are at higher slabs and marginal rate is now applicable, you may also look at some of these, multi-asset kind of a strategy, because it then, now with the new, regulations that are there, up to 65% equity, it is equity, and less than 35 is, marginal rate. But between that, you really can have, debt taxation with indexation.
Got it.
So
okay.
one could also look at, multi-asset as well.
Okay, got it. We are getting a lot of queries. Let me take them very quickly. Omkar Vyas has written to us where he says he's added an electric vehicle thematic fund, which is the Mirai Asset Global Electric and Autonomous Vehicle Fund. And he wants to know if he should stick to it or he should, move out.
So, again, I'm saying the personal advice in personal finance, right? It's very important for one to know why one has invested into. Right, so to Omkar, my suggestion would be that if you have just recently invested and you've gone with a purpose, let that story play out. But on an overarching basis, it's great because it's forward-looking, right? We all know the emission norms and how, the entire transformation that's happening in the automobile space. So it looks good. And
it looks good.
Yeah.
Okay, so you may want to perhaps hold on to that,
That's
Omkar. Right. Shreyas Rao has written to us where he says, what's the portfolio advice for college students? What percentage of portfolio to allocate where? So, just make it crisp for us, right? How much should you allocate as a college student? And give us 2 or 3 top funds that one should look at.
So, the model portfolio that I just kind of spoke about, right? So if you're a college student, I think I'm assuming that you have a long-term horizon, you have the ability to take risk, and hence my suggestion would be to be a growth-biased investor, which means almost at least 80 to 90% should be in equities. Within equities, the suggestion is that be into large, mid, and small, the entire category. If you do not have financial acumen or this thing, then just stick to those flexi-cap type, which is going to be long-term in nature. If you can play tactical, thematic stories, then we believe that banking and infra is something that you can add.
Okay, let's revisit the names then finally before we end. The top 2 large cap funds, top 2 mid cap funds, and the top 2, hybrid funds that you like.
Sure. So on the large cap bit, my suggestion would be go for an ETF. You could pick up an ICICI, an HDFC, and SBI, any of a UTI, any of those large ETFs to invest into, or an index fund, which is, say, a Nifty 50 index fund, again from any of these large names. On the mid-cap side, you have the Kotak, mid-cap fund. You have the Mirai mid-cap fund, so you could look at those as well. And on the short term, again, you have one from Kotak. Specifically on thematics, you could look at the Tata Infra or the Nippon,
banking fund, the Nippon banking fund
Nippon
that you
fund,
like.
yeah.
Okay, all right. We've run out of time, not out of questions, but thank you so much for joining us. It was really a pleasure speaking to you, and hopefully we will get to chat yet again on many more topics.
Absolutely, Sonia. My pleasure, and thank you, and thanks to our investors.
Okay, thank you to all our viewers as well. You can keep giving us feedback right into us, and with that, it's a wrap on this edition of Smart Money. Thanks for watching.